Hey everyone, I'm Shannon from Code Red Financial. If you're looking to buy your first home, you're in the right place. Today, we're diving into the exact steps to help you secure your purchase sooner. For most first-time buyers, making a standard monthly mortgage payment is entirely doable. The actual wall keeping people out of homeownership is that massive lump sum due at closing. Depending on the price of the home, pulling together anywhere from $5,000 to $50,000 in upfront cash creates a gap most people can't bridge on their own. That is where down payment assistance, or DPA, programs come in. These grants exist specifically to provide that upfront capital for buyers who have reliable income but low cash reserves. And we need to be clear about what these are. Unlike a standard loan that accrues interest over 30 years, a true DPA grant does not have to be repaid. It is capital provided to you without a debt obligation. There are billions of dollars sitting in these funds across the country. The problem is that finding them requires navigating a highly fragmented maze of national entities, state governments, and local nonprofits. To pull this off, you have to understand the core trade-off. The more massive the grant you seek, the more geographic flexibility and long-term mobility you must sacrifice. Let's figure out where you stand. Broadly speaking, first-time buyers fall into three profiles: the urban high-cost buyer, the moderate-income suburban buyer, and the revitalization buyer looking at up-and-coming neighborhoods. Identifying which of those three profiles fits your life dictates which tier of the grant ecosystem you need to target. You'll be choosing between two different paths: broad national programs that give you wide options, or high-power local city initiatives that offer much larger payouts. If you apply for a program that doesn't match your profile, you will either leave tens of thousands of dollars on the table or face an automatic rejection. Let's start with the national programs. If you are a standard buyer looking in the suburbs or a rural area, this is your most accessible starting point. This 3D matrix compares assistance tiers, starting with the National Homebuyers Fund, or NHF. It offers grants covering up to 5% of the purchase price. As a national initiative, you can use these funds across multiple states, giving you high flexibility. The trade-off for that flexibility happens during the application. Because the NHF manages funds across the whole country, buyers must meet firm credit score thresholds and remain under strict income maximums to qualify. Now, compare that nonprofit model against corporate bank initiatives, like Bank of America's grant or the Wells Fargo Neighborhood Lift program. Instead of a percentage, these banks offer flat payouts. You can secure $10,000 from Bank of America or up to $17,500 from Wells Fargo, but the banks demand a geographic trade-off. They target specific urban zones. If you want that $17,000, you generally have to buy within city limits, like Chicago, Los Angeles, or Miami. National programs are effective financial boosters, but if you live in a truly expensive real estate market, 5% may not cover the entry cost of the home. That brings us to the high-value local route. When national funds fall short, state and city-specific housing agencies step in with much larger checks. Take the New York City Home First program. It offers eligible first-time buyers up to $100,000 in down payment assistance. The trade-off for a six-figure payout is time. Those funds are forgiven over several years, meaning you are locked into a residency agreement. If you move early, you break the agreement and lose the grant. In Washington, D.C., the Open Doors program pushes the cap even higher. Depending on your income and the home price, buyers can receive up to $202,000 in assistance. This allows renters in the district, who would otherwise be priced out by property values, to enter the market. By accepting the residency requirements, a family can bypass the six-figure cash barrier that exists in high-demand neighborhoods. Statewide programs offer a middle ground. California's Golden State Finance Authority offers a 5% grant, maxing around $15,000, available across the state. Statewide grants are built to make living attainable outside of just the major metropolitan epicenters. You'll also find funding in neighborhood revitalization programs. Texas offers a $35,000 neighborhood stabilization grant, and Maryland's Smart Buy offers up to $15,000 for homes needing renovation. The specific trade-off for revitalization funds is the location. These programs require you to purchase property in distressed or redevelopment-heavy neighborhoods. Hyperlocal grants provide the massive cash injection needed for entry. However, they only work if you are willing to legally bind your future to a very specific zip code. Now for the reality check. If you are wondering why more people don't use these, the reason is the friction. You will face an exhaustive document gathering phase. Expect to submit years of tax returns, track pay stubs, and explain details on credit reports. On top of the paperwork, many of these programs force applicants to attend mandatory homebuyer education classes before the funding is approved. It shifts your timeline, forcing you to pause actual house hunting until you've secured the funding commitment. This is why you must partner with a real estate agent who is specifically certified in local DPA programs. Standard agents often lack the experience to navigate this specific red tape. The true cost of free capital is extreme patience, exhaustive organization, and a delayed schedule. This flowchart lays out your two main paths, based on local market cost and personal mobility. If you are buying in a moderately priced suburb and value the flexibility to move out of state down the road, follow the mobility path. Your best targets are the NHF or broad state-level funds like Michigan's MSHDA or the Illinois Housing Development Authority. They offer boosts with minimal geographic anchoring. But if you're priced out of your local metro market, take the high-cost path. You need to hunt specifically for those $50,000 plus city grants. Accept the education classes and the long-term residency rules to secure the cash. Your immediate next step is to look up your state's specific housing finance agency online and see what localized funds are actively accepting applications. Viewing DPA grants as a strategic trade of flexibility for capital helps you reach homeownership years ahead of schedule. The journey to secure a down payment grant is administratively taxing. You will spend hours digging up old paperwork, but the financial support is real and available if you prepare correctly. Collect your tax returns, identify your program, and start the application today. This video is for informational purposes only and does not constitute financial or investment advice. Consult with a qualified financial advisor or tax professional before making any decisions about your investments or retirement accounts.